Institutional investors considerably impact market movements, stock prices, and general market stability. Understanding their position and impact can help individual investors make better selections. In this video, we'll learn about institutional investors, their methods, and their effect on the stock market. 1. Who are institutional investors? Institutional investors are organizations that make big investments in securities, real estate, and other financial assets. They contain entities like A. Pension funds. These funds manage employees' retirement savings by investing in a diverse portfolio that generates profits for future payouts. B. Mutual funds, investment firms that pool funds from multiple investors to purchase a diverse portfolio of stocks, bonds, and other securities. C. Hedge funds, private investment funds that use a variety of tactics to generate high returns while taking on larger risks. D. Insurance companies, businesses that invest premiums collected from policyholders to cover future claims and create profits. E. Endowment funds, investment funds created by foundations, universities, and other institutions to supplement their operations with investment income. 2. Strategies for institutional investors. Institutional investors utilize a variety of tactics to attain their investment objectives. These strategies can impact their activity in the stock market. A. Long-term investing. Many institutional investors, including pension and endowment funds, prioritize long-term growth and stability. They invest in firms with strong fundamentals and growth potential. B. Active management. Some institutional investors actively manage their portfolios, purchasing and selling equities to outperform the market. This technique necessitates thorough study and market analysis. B. Passive management. Others prefer passive management, which entails investing in index funds or ETFs that replicate market indices. This technique seeks to duplicate rather than outperform the market. 2. Arbitrage. Hedge funds frequently use arbitrage tactics to capitalize on price differences between related securities. This may entail complicated financial instruments and colossal leverage. 3. The power of institutional investors. Institutional investors greatly impact the stock market since they control vast amounts of capital. A. Market liquidity. Institutional investors add liquidity to the market, making it easier for other investors to acquire and sell securities. High liquidity typically results in cheaper transaction costs and more stable prices. B. Price discovery. By doing extensive research and analysis, institutional investors help to identify the fair value of companies. Their trades reflect their assessment of a company's prospects, impacting stock prices. B. Market trends. The investing actions of institutional investors can influence market trends. When a huge institution purchases or sells a significant amount of shares, the stock price might rise or fall, potentially prompting other investors to follow suit. D. Corporate governance. Institutional investors frequently own large holdings in corporations and can exert influence over corporate governance. They may advocate for changes to management, strategy, or operations to increase shareholder value. 4. The advantages of institutional investors. Institutional investors provide various benefits to both the stock market and individual investors. A. Professional management. Institutional investors hire professional fund managers with the knowledge and resources to make sound investment decisions. B. Diversity. By pooling huge sums of money, institutional investors can increase diversity and distribute risk across multiple assets and industries. D. Stability. Many institutional investors' long-term investment horizons help to keep the market stable. Their consistent investment strategy can assist reduce market volatility. 5. Risks and challenges. Despite its benefits, institutional investors present risks and challenges. A. Market influence. Large trades by institutional investors can cause major market changes, including short-term volatility. B. Herd behavior. Institutional investors may display herd behavior in which they mimic one another's investment choices. If the herd follows suit, this might result in asset bubbles or market crashes. C. Conflict of interest. Institutional investors may have conflicts of interest with the companies in which they invest. For example, an investor might prioritize short-term gains over long-term health. 6. Role of regulation. Regulation is critical to maintaining the stock market's stability and fairness. Regulatory organizations monitor institutional investors to ensure they follow the rules and regulations that safeguard the market and individual investors. Regulations serve to prevent fraud, provide transparency, and retain investor confidence. To summarize, institutional investors play an essential role in the stock market by affecting liquidity, price discovery, market movements, and corporate governance. While they provide several advantages, such as expert management and market stability, they also carry hazards that can impact market dynamics. Understanding institutional investors' roles and effects can help individual investors navigate the stock market more effectively and make better investment decisions. If you enjoyed this video, please like it and subscribe to our channel.